A+ trading setups, the pinnacle of what to look for in the markets. If you don't have a playbook or you don't know which trade setups are a better quality, this series is for you. Starting out with first red day and first green day, we're going to be going through and identifying and characterizing these setups, as well as showing you exactly what to look for on the day itself for you to take great trades. We are just going to dive right into the nitty gritty, but before I get into the actual slideshow for this video, which is, by the way, down in the description below, it's free. You can download it, you can print it, you do whatever you would like with it. I'm going to walk us through an example on the NASDAQ from last week. This is a trade that I did actually take because it really starts to sum up what to look for just in this chart. Last week was a fantastic weekly template. We can very easily identify this trade setup before the day has even begun. So on Monday, we had the opening range for the week. Now, I'm just going to mark this off to illustrate that that is the weekly range as of Monday and Tuesday. And notice that Tuesday was an inside day. We're just going to ignore all that because when you see the slideshow, you're going to understand how to identify these first red day setups. One of the properties of that setup is you must have a large pumping day. That is part of the equation. If you want to think of it like a math equation, A plus B equals C. And you cannot get a C without both A and B. So if I were to label this off, we have this large pumping day, which actually took place over the course of 2 days, Tuesday and Wednesday. But this overall is going to be your A. All right, we've got A right here. Now, the next part of identifying the first red day setup is going to have a day that has opened. That is the opening price of the day. So like if I were to mark this off, notice I have a daily separator here. The opening for the day is the very first candle that prints. That is the price that I would consider the opening price for the day. I'm going to label this off right here. Oh, no, we're going to do this right here. And next, the next part of the equation, we need a day that has traded up through the previous day's high and made an attempt to go higher. And then at the end of the day, that should be failing and closing back down below the opening price. So that would give us B. At the conclusion of that day, once that closes, we can say, okay, we have A plus B. Now I need to look for C. So we had the large pumping day, a day that's opened, attempted to go higher, and then failed below the opening price for that day. Now we're going to come over to C. I am looking at a few things in A and B. I need small details in there that will help me to identify the setup on the day. But in this instance, the context of the market is always very important. So I'm looking at market structure. And in this case here, you can see that my daily open was also the low of London, which was also a minor low. So when they came down here and they broke that low, that is a break in structure to the downside. So break in structure to the downside. Okay, so we have a break in structure to the downside. Now, my automatic belief, whenever there is a break in structure, is that I am going to need some kind of retracement. And that retracement is going to come in the form of 3 pushes. Now, sometimes that retracement could be 3 candles. Sometimes that retracement could be some kind of stair-stepping pattern that takes more than 3 candles. Or sometimes that retracement could be 3 sessions over the course of an entire day, which is exactly what happened on the NASDAQ. So in this case here, we do have a lower low in place. And then over the course of an entire day, they've pumped up off the low, push 1. Sideways, London was push 2. And then New York was push 3. Now, I understand that I'm going fast, so if you need to rewind this and watch this a couple times to get the steps down, feel free. However, I'm going to go over all of these steps again in the slideshow, so don't worry. So they come back up off the low in 3 sessions of rise or 3 pushes. My common belief is that they are trapping volume above the second push, and I need to look for evidence of that. So I caught this as push 1 and 2. So what I did was I drew a line above London's high. All right, so I had second push, third push back up into the high. And then everything from there revolves very heavily around timing and the behavior of price at certain levels. We're at the high of the day. We're on that third push. We get this nice little M at the high of the day, up, down, up, engulfment. And then all I need to do is let the rest of the timing play out in order for me to take that trade on a lower time frame. Okay, To recap real quick, overall, what am I looking for on the day? It depends on the structure of the market and my understanding of breaks in structure and 3 pushes. I am making sure that they don't come back and invalidate my trade. In this instance here, this was a lower low, making this a high, and I had told myself if they go above that high, I'm going to invalidate the setup. But in most cases, my invalidations for a first red day is going to be if they were to make a new extreme. If they went back up and made a higher high above the previous day's high, I would no longer look for this setup and I would move on. In this case, that didn't happen. All of this was 3 pushes back up into the high for this move down that you see right here. Let's get down to the lower time frame and take a look at what happened around 9:30 on this pair. So on the 1 minute chart, we zoom in a little bit here and you can see that they were making higher highs and higher lows on that 1 minute chart leading into the session. Good stuff. And the 15-minute chart had already broke structure to the downside, so all I needed was the 1 minute chart to break down and then my timing to kick in around 9:30. So after making a series of higher highs and higher lows, they do give me that lower low right here. This is the break in structure to the downside, BIS. And following that, we have this lower low again. So now we have a break of structure, a continuation pattern down further. Awesome. Once they come down here, I'm going to mark off that 9:30 candle right over here. Now, this is exactly when I knew I wanted to take this trade. This consolidation right here, they made a lower low. Like I just said, after they make a lower low, my automatic belief is that I need to wait for 3 pushes, especially around my time of day that I look to take my trades, and I'm looking for a very specific behavior of price in order for me to believe that this could continue to go lower. I need to see behavior that they are going to be trapping longs. So if I have push 1 and push 2 and my belief that push 2 is the trap, you can see that once they've got people stuck in this upwards move, they retest it again in a 1, 2, 3, and then they fall away. This fall away, they made another lower low. Now, I just need a chart pattern at this point in order for me to get into this trade. I'm going to look at the 9:30 candle right here. Notice that this bullish engulfing candle right here, the one that went straight back up, notice how it does not close above those prices. So if my belief is that people are stuck up here at the high of this consolidation and that candle has gone vertical, the biggest candle you've ever seen on the entire chart, and then it has just immediately gone back into consolidation and stopped without letting these other traders out. If anybody went long in this area, they are still stuck. This next engulfment down, followed by this up close candle, followed by this down close candle, is going to give me the M that I need in order to complete the criteria for my trade. I entered on this candle here at the break, and I added into this position as it was falling. This was an A+ or a high quality trade setup, and I was able to hold on to this for 60+ pips with size. Very good trade. Very great day. This has been a great week. If you felt really lost in that last walkthrough, go back, please watch it again. See it a few times, leading you into the rest of this explanation, because having seen it a few times, even if it is a little bit confusing, and then getting into this information, that information that you saw in the walkthrough is going to stick a lot better leading into this class. Great. So now that you've gone back and watched that a couple times, and you've came back to this point in the video, let's get into identifying first red and first green days. What do I need to look for? So like I said, A plus B equals C. You cannot get a C without having both A and B. You need a large pumping day. That's going to be A. So in this example here, you notice it's Monday, Tuesday, Wednesday. On Monday, we had this large vertical day. You might be asking, well, what is a pumping day? You can see that they have visually taken the market from down low and went vertical and brought it up high. There's a lot of space between the low and the high. That was what I would categorize as a large pumping day or a large dumping day, obviously in the other direction. I need a day that opens, attempts to trade higher, and then closes below the opening price for that day. This behavior here is going to give me that first red day. And then the combination of A plus B is going to allow me to believe that on the following day, that behavior is actually going to play out, and I can start looking for sell high opportunities over here on C, which would have been on Wednesday in this instance. A sell high opportunity is going to be from the high of the day, the high of the session, or maybe even up close to the previous day's high or something like that. But regardless, I want to be selling high within the day's range. And I want to be selling high within the overall weeks range as well, because these setups are designed in order to allow the market to fall through all of the space that was created during this pumping day over here on the left. And then identifying a first green day is very simple. It is just the mirror of the first red day. You have a large dumping day. Somewhere in there, you're going to have a place where that dump has began. And then you're going to have a day that has opened, attempted to trade lower, and then closed above the opening price for the day, looking for a buy low opportunity on the next day. Low of session, low of day, low of week, low of previous day. Those are the areas of the chart that you want to be searching for your trade. So now you know how to identify first red and first green days. However, there are some other things that you can do, or ways that the market behaves, that can tell you or give you an indication of which ones are better, and then which ones are necessarily maybe not better, but not as great as some of these other ways that the market will behave. Sometimes you'll get a first green day and it goes vertical to the downside, and you're wondering, well, why did that happen? Why did it roll over? Or you get a first red day and it goes vertical to the upside, and you're like, I don't understand. You know, Cam said it's going to... No. I'm going to show you all some things now that I look for to help to give me an indication of the better first red and first green days. All right, so over here we have on day B, did price close at the extreme of the day? So look at the chart here. We have multiple days of shorts in the market. We have a day that is opened, traded lower, and then closed up high. All right, so we have the dump, we have A, we also have B, giving us the first green day, and now we're looking at C. We would be looking for a buy low opportunity. But what we're going to look at right now is, how did this day over here close? All right, so there's some things that I can look for in order to say, hey, this is a better setup or a worse one. One of those things is going to be the 50% of this range, this dump, your dumping day. Remember I said that these setups are designed to have a large dump, a consolidation, and then a pump, and it's supposed to go back up through where that dump began. So if you are closing up above 50%, or maybe up where you believe the dump has began, that's not going to give the market nearly as much space to travel through in order for you to actually get a good risk to reward, which is what we're looking for these A+ setups. All right, so let's look at this chart. Big dump down, break in structure to the upside, and the close at the extreme of the day. That leads me into the next thing. I don't really care for when these close at the very highest point in the day on a first green day, because what I have found is that a lot of times they will start maybe bouncing off the 50%, and then it will just roll over on the following day. So typically what I would like to see is them to break lower and then close just slightly above the opening price for the day. Number one, that gives a lot of space for the market to travel. And number two, that gives this a small range or a tight range for them to maybe break structure to the upside, give me 3 pushes back down, give me a good short or long squeeze setup from the low of the week or from the low of the day, and I can get my maximum risk to reward up through those highs. Now, in this instance, they did close at the extreme, but then they continued on the following day. Why did that happen? We're going to talk about some behavioral things about looking to the left, some indications that you can look for where volume is trapped within these past few days that could give you an indication of why they're not going back down or why they're not rolling back over. All right, so another thing that I want to look for, bullet point 3 over here, structure. If I could put in all caps and highlight market structure 50 times and just throw it up on the screen so that it was just scrolling, so that way you always remembered, I would do that. Breaks in structure or of structure. I always want to be aware of my levels. All right, so this is actually an hourly chart, and just observe. We have a low. Then we have a high, then we have a lower low, then we have a high, then we have a lower low, and they have a minor break to the upside, break in structure to the upside. What did I say was my automatic assumption after I get a break in structure to the upside? I need 3 pushes back down, and you can kind of see over here that they are jamming people back down low in the daily range. The range on Tuesday, they're jamming people in order to continue that trend back up through the high. All right, so really paying attention to structure. It tells a lot of the story, or a lot of the pieces of the puzzle that you need in order to make accurate trading decisions. You're observing the major levels, you're observing the minor levels, figuring out if you have a major level really far away and they get a minor break in structure, that could be a strong retracement back up towards that high. And that would be still a very good trade setup in my mind. The next thing I want to consider, How many days of rise or fall were prior to getting my first red day or first green day? I don't want to be going up for multiple days and then get a small down move and then be like, oh yeah, first green day. No, I want the market to have been traveling down for a period of time. Could be 2 or 3 days. It could be over the course of maybe multiple days, more than that, maybe like 4 or 5 days, something like that. And then I get a first green day. Those are typically going to be the ones that I find to be more reliable because the market is overextended and they have to go back for the money eventually. Eventually, they're going to exhaust their capital or whatever it is, the market maker, the algorithm, the institutions, whoever it may be, and they have to go back to basically reclaim some of their hedged positions, right? If they're driving down into the low as the market's going down, they are buying, and eventually they have to balance their books and go back up to reclaim some of that money. And on that note, let me know down in the comments below, what are you truly struggling with your trading? I'd be happy to answer those questions or even make a follow-on response video to all of those questions in the future. Enjoy the rest of the video. The bread and butter. The only 3 scenarios that I look for after a first red day or a first green day. It's very simple. Number 1, if it's a first red day, I automatically know I need to look for a sell high opportunity. I've already laid out those areas. High of day, high of session, high of the previous day. Those are all areas that I could be looking at as areas of interest in order for me to take this trade. If it's a first green day, then I'm going to be looking for the opposite. A buy low opportunity. Low of day, low of session, low of previous day, all of those areas. Buying low within the weekly range and selling high within the weekly range and, of course, the daily range. All right, so what are my 3 scenarios? I have a end of day consolidation, breakout, pullback, continuation scenario. I have a breakout to the upside, failed breakout, and reverse sort of scenario where they go back up and retest a area of trapped volume. Or I will have my invalidation. My invalidations is going to be, so if this was a first red day here, which it was, my invalidation, where would I say, hey, I'm no longer going to watch this trade? The previous day's high. If they come back up and they hit the previous day's high on day C, so we have A, pumping day, B, first red day, C, they come back up and they hit the previous day's high and close candles above there. On the 15-minute chart, I am going to invalidate that trade setup. The actual times when I'll look to take the trades, you have end of day consolidation, breakout, pullback, continuation. The only 3 things that markets do is breakout and trend, breakout and reverse, or stay inside of a trading range. So if we break out and pull back, that might be a good opportunity to take my trade. On the other side of this, if this is a break in structure to the downside, which it was over here, they might need to do some kind of retracement real quick to stop hunt into everybody who got this correct. They got the direction correct, but they have timed it incorrectly. And that is when they are going to break out of the end of day consolidation, come back up to retest the highs, and then maybe I will get my trade from there. Timing is the most important thing to me. Looking for maybe 3 sessions of rise up into that high. But most importantly, like I said, timing. I'm in my session, and around 9:30, the market opens up, and I get my price pattern all leading up into 9:30 that would allow me to believe that this is going to continue in the downwards direction in that now existing downtrend. They made a lower low, they pumped it back up into the high, consolidated, and then rolled over to continue that downwards trend. Well, you might be saying, well, that's great, Cameron. Those are all really broad spectrum ideas, but you need to be more specific. Where do I get in? What do I look for down on those lower time frames after I had all those bigger ideas on the higher time frame, 15-minute? And I agree. Let's get down into a lower time frame and look at what an entry could look like on one of these pairs. So I have a daily process, and I have videos on my channel about my daily process, what to look for on the day prior to identify those setups. So like we just looked at A plus B. You have to identify that the day before you actually look to take your trade. And that is what the daily process is laying out. I'm looking at market structure on the 15-minute chart. I'm looking at the opening range, and I'm looking at signal days. Those are the 3 things, the 3 must-haves every single time I do my analysis. Then coming down, actually on the day itself, the process of looking for the trade on the day. After a first red day or a first green day, I'm going to have one of 3 scenarios that I described in the previous slide. End of day consolidation, breakout, pullback, continuation, an invalidation scenario, or a breakout and a retest of trap volume, either up high or down low, depending on first red day or first green day. In this example here, the previous day was a first green day. So let's take a look at structure on the 1-minute chart leading up to this trade. We had a downwards moving market or a consolidation, and then we had structure. If the 15-minute chart just made a higher high maybe the day before, or maybe even on the day itself, and they are going and doing 3 pushes back down, that means the 1-minute chart is in a downtrend, and I need it to flip around and get in alignment with the 15-minute chart, looking for traps down low. There should be trapping shorts. There should be behavior that shows me that that is what they are doing. So in this example, you notice that we have a high, and then we have a low, and then they spike up into the high, making a higher high. That is a break-in structure to the upside. Now, in reality, they could have just rolled over and kept going lower, and that would have been perfectly fine. However, that's not what happens. Huge spike to the low, push 1, and then they go sideways. And then they drive into the low again, push 2, and then you get this third drive into the low, ending in a 1, 2, 3 to the low, down, up, down, engulfment. That is a W, and that is a part of my entry criteria. The way that I just walked through that setup, creating a high, creating a low, break-in structure to the upside on a 1-minute chart, and 3 pushes into the low, followed by a chart pattern, M's, W's. That is the last part of the criteria before receiving the engulfing candle right here. They have taken out the middle structure of that W, and that would be my first entry every single time, followed by scale ins as necessary. All my videos, I am constantly talking about different concepts, and I've made it pretty clear that you need to understand all of those concepts separately. Because if you understand them all separately, the big picture becomes more clear. And we're going to go through some of those concepts now that is going to really give you an edge in looking for levels, understanding where people are trapped, and then it gives you an extra confluence when you're entering that trade as well as when you're managing that trade. Let's say, for example, if you believe that people are trapped down low and you have identified behavior that says people are trapped down low, and your criteria for entry is finishing out and you're about to get in, and you get into that trade and it starts to climb a little bit but rolls back over, maybe people are not trapped down low. You might have something wrong or you misread something, and that could give you an opportunity to get out much faster than if you were to just put your stop down at the low somewhere and just let the market play out and do whatever it's going to do. It really does give you an edge in the market, keeps your losses very small, and then also gives you confluence when the trade is going in your direction by looking at the other side of the trade. Let's say you're taking a long and you say, hey, this is where shorts are trapped, but this is also where longs could be trapped, and then the market starts to move up through those areas. Hey, that's an extra confluence to my trade that I'm managing this correctly. They're pushing up through where those longs should be trapped based off the behavior, and that means that they're not trapped and that this actually could be the correct direction and I'm in the right trade. I should hold on and I should allow it to actually play out. All right, so let's talk about the concept of consolidation. Consolidation is defined by a high and a low and all of the price movement that lies in between. So we have a high and a low that's dedicated by this blue box here, high and low. And this blue line would be price. So, concept of consolidation. I have 2 options: breakout, pullback, continuation, or a breakout and a failure. So if you have a consolidation and they break out and that price starts to fail, my idea is that they will go back, or they should go back to at least the 50% of that range. They could put in a base and then continue. Or if the breakout continues to fail, you're looking back down to 100% of that range. Now, remember, concepts are fractal. Consolidations could literally be all the way down on that 1-minute chart. But typically, you're going to be looking for larger consolidations on like the 15-minute chart and then applying this concept to that. Over here on the right, you have a consolidation still dictated by this blue box here and price as the blue line. This is the breakout and trend option. So if you have a breakout and 3 pushes back down, maybe this was a higher high. Maybe they made like a break-in structure or break of structure outside of consolidation. And then you start getting 3 pushes back down, inducing people to take a short, and the breakout is not failing. That could be your long trade for a trend trade continuation. Now, in these instances here, I get a lot of questions about, hey, when do I use range expansion and things like that? This is exactly when. Breakout, pullback, continuation. I'm looking for a range expansion of whatever that consolidation was, that high and that low, and applying this 100% equal distant expansions of that range to find my targets. One of the most important concepts you will ever learn. By far, the concept of trap volume and 3 pushes. 3 pushes is a way of trapping volume, and trapping volume is what the market must do in order for it to reverse. Okay, this could be in a pullback. They will trap volume in a pullback. They made a higher high, those 3 pushes back down. The purpose of a pullback is going to be to start to induce the other side of that trade. It's also going to be shake out all of the people that got the trade correct, but they have the timing wrong. And it's also going to be to stop out the people who have the direction correct, but the timing wrong, and they have moved their stops too aggressively and too tight. All right, so 3 pushes back down, higher high, 3 pushes back down, and maybe a W for a continuation. That is a very good possibility. Like I said, consolidation down low, breakout, pullback, continuation. You might have a range expansion of this consolidation down low. However, when the session begins, they come out of consolidation, push 1, push 2, push 3 into the high. I'm looking for behavior where they are trapping above push 2. Usually push 3 will blow off in the direction of the trend. Why would they do that? Because that gets people trading in that direction so that they can very aggressively take it away from them. I am paying attention to the close of these candles, because all of the books tell you in an up move, buy the close of strong up close candles, strong candles that are closing higher and higher. That's what you're supposed to do. And that is very predictable for the other side of the screen, right? You get to the third push. Obviously, somebody probably went long off of that candle. That's the biggest candle there is in that entire upswing. And then they immediately reverse back down, up, engulfment back down. And that has just trapped. If you went long on this candle right here, if you went long on this candle right here, that candle right there, or obviously that candle right there, if you draw those closes across, that one candle there has just trapped you in those longs, and then they eventually collapse and fall away. All right, so how do I identify trap volume? It's all about 3 pushes. It's all about the level. Notice that there's also a previous day's high right here. That is a very good area to look at for a potential area for trap volume. High of day, also very important. Previous sessions high and low, those are consolidations. Let's use London for an example. London has a high and London has a low. They come out of London's high in 3 pushes. It's a first red day and they go into consolidation. Hey, we're at the high of the day. We're at the high of the session. They've done 3 pushes outside of consolidation. 3 pushes exhausts a move. That could be a trade. All right. That's all I'm looking for. I'm looking at the candles. I'm looking at the level, and I'm looking for 3 pushes with the understanding that above push 2 could be the trap volume. And then I just have to wait for the timing to kick in, 9:30, and waiting for the behavior of price to let me know that they might have people stuck in an area, because that gives me a lot of confluence for my trade. And of course, allowing my entry criteria to play out and then entering into the market accordingly. Going through last week's trades and looking at the weekly templates, let's look together and find some first red and first green days and look at the behavior of what has happened. This is oil on the 15-minute chart, and I'm going to read it from left to right, just like a book. If you try to read a book from right to left, you're going to probably be really confused and be speaking gibberish. So let's look at Monday's opening range. All right, there's Monday's opening range. Failed breakout down at the low of the week, and then they went higher on Tuesday. So that is breakout, push 1 outside of the opening range, and also 1 day of breakouts. Then we went higher on Wednesday. That is now day 2 of breakouts, and also push 2 outside of the opening range. Fantastic trading opportunity over here on this Thursday, looking at 3 pushes outside of consolidation on the 3rd level as well. So we have 3 levels ending in 3 pushes, also 3 levels outside of this consolidation. Previous day's high, noticing the push 1 and then push 2 up to London, and then push 3 up to New York. So what happened in that 3 push pattern? Above push 2, they have volume trapped now at the high of the week. And in New York, they had a bit of a first mouse pumping back up into the high. You could see the nice 1, 2, 3rd level to the high, 3rd hour trade, 10-15, engulfment back down to the downside. What did that do? We have volume trapped above push 2 outside of consolidation, and also in the 3 push pattern back up into the high. If I were to mark this off above push 2 on a lower time frame, on a lower time frame, that would have been a wonderful trade to look for. All right, but let's identify the first red day that has occurred. We have a large pump throughout the week that has began all the way down here on Tuesday, something like this. So I can mark this off and say, hey, this is probably where that pump began, because that was push 1, 2, and 3. Again, I'll say that again. That's where I believe the pump has began, because that was the beginning of the 3 pushes, or the 3 levels to the high of the week. And that is exactly where you want to see these first red day trades take place, at the high of the week. All right, so that is where my pump has began. And then we have a day that is opened. It has traded higher or attempted to, and then failed and went back down, hit the previous day's low, and closed below that opening price. Now, this trade setup did not close quite at the extreme. It pumped up back off the low, but it is down pretty low, not only within the weekly range, but also within this day's range, not leaving too much space to get back down to where that pump began. So the following day is going to give us a lot of information. On the following day, today, Friday, they have pumped up off the low over the course of 3 sessions, almost exactly like I just showed you on the NASDAQ example, where they have gone up and pushed sideways, and then they pushed up to London, push 2, and then New York to push 3, and went sideways. So the only problem with this is the large move actually happens outside of the timing window. Sometimes this happens, sometimes it's just not the right timing. This is our 3-hour window in New York, and sometimes the move will just happen afterwards. And that's kind of one of those things. I'm not at the screen over here, so if it happens, it happens. However, the pattern remains the same. Regardless of what time these things are taking place, the setup is the same, and the pattern remains the same. So let's take a look at the behavior on the day itself. We had made a lower low down here, and we had a bit of an end-of-day consolidation, something like this. This would have been our range. So all this is 3 pushes back up off of the low. There was a break in structure on the previous day, on that Thursday, where they made a lower low. Understanding that once they make a lower low, that we need to see 3 pushes back up into the high. There we go. 3 sessions of rise, 3 sessions set up. And then in the last leg of this move, noticing push 1, sideways, push 2, and 3 to the high. I believe that people should be trapped above push 2. You could even look at the breakout of this consolidation here, 1, 2, 3 to the high, and draw this across. Funny enough, that's push 2, and when they break back down, notice where they are jamming candles back up. Boom, boom, boom. They just keep hitting that same level over and over again. That's the behavior that I want to see to indicate, hey, there could be people trapped above push 2, buying these candles into the high, and now they have them stuck up there, and they're going to punish them to the full extent. Let's go down to the 1-minute chart, and although not in the timing session, let's just take a look and note the behavior of what's happened. So this is where I believe that people should be stuck. They're making higher highs and higher lows dictated by these levels that I'm about to draw. All right, so they made a low, then a high. There was a high and then a low, and then they went higher, which would have confirmed this as a low. And then they came up, they made a high, a 2-candle pullback, and then they did break structure back down to the downside, creating a high up here. And then they traded back down into the low. Right, so making lower lows and lower highs, and then they broke back up to the upside, which means that on a 1-minute chart, this was the major low in place, and this was a major high on the 1-minute chart. So all they're doing at this point is trading back up into a major high over and over again. And then they do break back down over here, making that lower low, pumping back up into the high over and over again, and eventually falling away over here. And you can kind of see that if this was timed better, once price comes out of consolidation and starts to open up a little bit, that is going to give you the best opportunity to sell high within this consolidation or sell high within this range, looking for some kind of M or W. It looks like there was an M right here, but that was the early trap for the retest, and then it did fall away. So this was levels that have been formed, 3 pushes back up into the high, but anywhere up in this range where I believe that people are trapped could be a safe area to sell. You're selling high within the day's range, you're selling high within not necessarily the weekly range, but definitely within the day's range, and it's got plenty of space from this point to get back down to where that pump began, which is exactly what I want to see for maximum risk to reward. It's 160 pips down if you were to have been in that move. It was very fast, and that is exactly how these things should move when these trades actually do play out. All right, I wanted to do an example of where a first red day or a first green day does not play out, and let's take a look at some of the things that maybe would have helped you to identify why you should not have taken this trade. All right, this is US dollar, Japanese yen. We've had multiple days of dumping down. There was a break in structure to the upside and a major break to the upside. And also understanding, hey, break in structure to the upside, especially on a major level, you might be looking for 3 big pushes back down into the low. This could have been the first mouse, which is exactly what this was. First green day, dump, a day that's opened, attempted to trade lower, and then traded back up and closing above the open. All right, now we have the end of day consolidation up here. Now, I want to point out, how did they come out of this consolidation? 1, 2, 3 to the high. Maybe the above push 2 is an area for institutional selling. And let's look at what happens. All of the candles on this chart that are very notable, what I mean by notable is that you have smaller candles and smaller candles and smaller candles, and then you have very large up close candles into the high over and over again, up into that area where there could be institutional selling. All right, so maybe this could have gone vertical and it could have continued. That is actually very possible. But if you understand the traps on both sides and you're watching for both sides of the market, the session opened up high in the daily range. Now, you could have looked to maybe buy the low of the session, but they have been jamming back up into the high over and over again without going any higher, and you do need to be very careful. Notice the close is nearly at the extreme. We have the opening range here. We've been bouncing off kind of in that area. They've gone back into consolidation below the daily open, and we've been slamming candles back up into that area over and over again, leading into the New York session, which is very different from what we saw in some of those other examples. Then you have engulfments to the downside, push 1, push 2, and maybe a weak push 3, a bit of a head and shoulders to begin the session. Where do I think people might be stuck? If this is push 1 and this is push 2, or maybe somewhere in that area, not only do I have this level here looking for where I believe people are stuck, but also that level lines up almost perfectly within that 3 push pattern. You could even look at it as like push 1, push 2, and then that was push 3. That lines up really well for where people could be stuck, and you have to be very careful. Let's go down to a lower time frame to see. So maybe it didn't necessarily invalidate the trade in the session or before the session began, but watching for these traps and understanding market structure, not only on the higher time frames, but the lower time frames, can really save you from taking a poor quality trade or one that isn't quite set up, the best. We had a low, a high, and they come down and break structure right at the beginning of the session, which means that the 1 minute chart is now in a downtrend. They start pumping back up into the high, leading us into that 9:30 time, which was about right there. 9:30 opens up and leads higher up into the high and then trades down. They go lower. So what did this bearish engulfing candle do? Well, it got people to start shorting. They immediately go into consolidation and go sideways. But let's look to the left and figure out if they're leading longs lower and lower, which turns into a long squeeze, which is exactly what you want to see to take a short. We have to be able to identify that behavior. So the candles that stand out to me the most would be like that one right there, that one right there. Some of these other candles that are, slamming back up higher, you've got this pattern up here. And as they continue to drag these longs lower and lower and lower, when they go vertical down, it's game over, and they've got everyone stuck, trapped, and I'm done. I'm out. This consolidation at the high of the day without going vertical should have been key, especially when 9:30 opens up and does not go vertical through the high. That is a good indication to just maybe stay out of that one and look elsewhere. Ladies and gentlemen, I truly hope this video has been of use to you. If it has, do me a favor. Hit that like button, subscribe to the channel if you have not already. It is the best way you can possibly support me. I do appreciate every single last one of you, and enjoy the rest of your day.